Yeah, hi traders. We've just seen the RBA statement dropping. We've seen the new projections in the economic projections in the statement of monetary policy. And kudos to the market. They absolutely nailed this one, whether you're looking at the options implied vol structure, which had overnight implied volatility running about 14% for Aussie dollar, indicating a sort of a 40-point move up or down in the Aussie dollar. So very low volatility affair expected there. Or whether it was the market pricing, where swaps are pricing about a 90% probability of the cut coming through. And of course, they got that one right with the 25 basis point cut we've seen with the cash rate now at 4.1%. Most economists obviously had this one down pat as well. Now, ultimately, what we've seen has been a low volatility affair, whether it's in the Aussie dollar, whether it's in front-end rates, whether it's in swaps, whether it's in the ASX and interest rate sensitive stocks. We haven't seen huge movement coming through. And I think that's partly because if you have a look at the statement that's come through, the central bank is still cautious. They've welcomed the pace of disinflation. In fact, they've actually said they've been quite surprised by the pace of disinflation coming forward. But they've said that their job is not done. Essentially, if they were to go too fast on looking to cut rates and ease policy, they could change that trajectory. So they're showing an element of caution about future rate cuts coming through. They've said the job market remains tight, but they've also said that the policy rate remains in restricted territory. That indicates that they obviously do have a preference to cut further down the line, but that's going to be driven by the data. So obviously watching the Q1 CPI numbers, the monthly CPI numbers leading into that, and then the Q2 CPI numbers, which come out in late July. Now, of course, trim mean inflation has been coming down. That's why we've been seeing the RBA cutting today. And we can go back to where it was sort of peaking, Q3 of 2022, where it's at 7.6%. And then literally every quarter, it's come down to where we are at the moment. We're at sort of a 6-month annualized pace of 2.7%. So that's right in the target bracket. So that's given them the scope to do that. But obviously, they've said if they were to ease too quickly, then that pace of disinflation could change. So they're probably quietly confident, but they're not patting themselves on the back. Their job is not done. If we have a look at really the swaps market and see how the land lies based on what we've seen from the statement today, we've got about 5 basis points being priced in of cuts for the April meeting, and then we've got a cut, nearly a full cut being priced in for May. So that cautious stance means they're likely to stay on hold in the April meeting, and we're probably likely to see another cut coming through in May, and then you go to the end of the year, and then they're pricing another cut for December. So it seems the market pricing is saying we're going to get another cut in May, we're going to get another cut in December, and that's obviously could be massaged depending on how the data comes through. If we have a look at the statement of monetary policy, and I think if you have a look at the expectations of the forecast for trim mean, that we've got trim mean sort of coming at 2.7% for the June quarter, and also 2.7% for the December quarter. So that's been taken down about 20-30 basis points or so. So it's pretty much in line with where the market was looking for. They've revised up their growth forecast a little bit, nothing too substantial, and they've sort of tweaked their unemployment numbers there as well. But trim means coming down to sort of 2.7% for June, and pretty much in line with market forecast there as well. In terms of the reaction in the Aussie dollar, well, initially we saw Aussie dollar trade 63.44. Dropped down sort of 10 pips or so. Then it did a big reversal, got up to 63.68. And we're just seeing a few sellers come through in the mix at the moment, pretty much at the flat line. Aussie Kiwi, which was obviously a rate sensitive pair, did trade a little bit lower initially, when we got the cut, but then it sort of pushed back up to 111.34, and then we're just sort of meandering where we are at the moment. We've got 3-year yields on the Aussie government bond there, pretty much unchanged from what we've been seeing, and 10-year yields up a touch at the moment. The ASX initially sold off, but then it's come back to the flat line. So again, what we've been seeing is this low volatility affair. It's really going to be data dependent from here. We're going to have to look at the data. It's going to decide everything, and obviously financial markets globally. But what we're seeing now from the statement is a cautious central bank that do not want to change this disinflationary cycle. The data is going to change that, but we're expecting at the moment another cut in May, perhaps another one in December. Let's see how it goes.